You're really focused on fast-growing companies. Can you explain your investing philosophy?
I think there's very few people that actually get what they want out of the market. If you can pick the winner out of those industries, you can do exceptionally well.
Given the amount of uncertainty at the moment, are there any sectors that you are saying, look, there might be interesting companies here, but I'm just not going to touch it? Are there any stocks that are like top of your watch list you're hoping they come down a bit and fall into your valuation range?
Hero or sidekick?
Welcome to Sidekick, the podcast where we uncover the hidden superpowers that drive some of the biggest, fastest growing companies and successful business names in the world. I'm Bryce and I'm joined by my regular co-host Ren, and we are your trusty sidekicks. Ren, how are you?
I'm very good, Bryce. Very excited for this episode. Today we are speaking to an investor who specializes in investing in fast-growing companies.
Yes.
We've spoken to him on Equity Mates Investing, but this is the first time we've had him on Sidekick. Michael Frazis, welcome to the show.
Thanks so much for having me on.
So Michael is the founder of Frazis Capital Partners. As Ren said, he's been on the show plenty of times. Has always left us feeling excited about the companies that you're investing in. So today, Michael, we're going to start with a bit about your story and your journey in finance, how you're managing the current market, and then close out with a conversation around AI. So can you share us your story? How did you get involved in investing?
I think I was just one of those guys. I'm sure there's plenty in your audience, who just got obsessed with the market. And, I think there's a typical journey everybody goes on. You start with Warren Buffett, you read all the value stuff, you read the same books, maybe a bit of Peter Lynch, and then you slowly try some stuff, and then you quickly realize it's a bit harder than it.
Yes. And then you become a professional.
Yeah, and then some people become a professional. But yeah, it's kind of to be honest, it's a tough game for a professional. I mean, I think there's very few people that actually get what they want out of the market. Or there's like a saying that everybody gets what they want, but sometimes what people want is, different to what they would think. For example, maybe they actually just want a bit of excitement and something interesting. And you certainly get that.
Yeah.
Well, you certainly get some excitement and invest in some interesting companies. As I said in the intro, you're really focused on fast-growing companies. Can you explain your investing philosophy?
Yeah, sure. So I think one of the differences we do is, there's a couple of differences, but first we go for really fast-growing companies. Like, I really feel like if you're an active manager, if you're trying to outperform, there's very little reason to be sitting in the same companies everybody else is. And to the extent that, you're setting up a business and you're trying to attract investors, you have to be doing something different, because there's such good passive products out there. And I'm sure most of your audience will be using those extensively. NASDAQ 100 ETF, for example, is a really good proxy for that, US tech trend that's been going our whole lifetimes. It'll probably continue throughout the rest of our lifetimes. But there is space for, looking at faster growing companies, earlier stage companies doing something different. And, in good years, they can significantly outperform. If you've got companies that are putting up organic growth rates of 100% plus year after year, they're often right at the top of the performance charts. And it's not necessarily obscure companies either. It could be NVIDIA, which did that for a number of years recently. And that was, the top performing large cap stock. So there's that kind of like revenue growth side, which just kind of narrows our universe down to a couple hundred stocks. And then the other thing we do differently is we really focus on the consumer, on the customer. So there's this idea that there's a decision point where everybody decides to pick one product over another, and really understanding that. And even if you don't understand it, just seeing what consumers do can really lead you in the right direction. So there's some old examples and some new examples. The old examples were obviously Apple, which we've talked about before. There were so many smartphone companies. Everyone had a BlackBerry, there was Nokia. And then when Apple released their iPhone, a bunch of new entrants came in as well. Everyone from Sony, LG, again, Microsoft, so many different companies were going for it. But there was only one company that people had queues outside. They used to set up tents, I'm sure you remember. And that translated into a 40% margin. And then everybody else had to compete on price and features. So if you think about, if you look at typical financial analysis of a company, you'll often get stuck in a cheap company that is competing on price and features. And generally those companies struggle. If it's in the auto industry, all the sedans have basically converged on one form. SUVs are one form. There's only a handful of companies that are doing something special that can actually attract a margin, often growing faster as well. So this would be Tesla back in the day, or you could look at Ferrari as another example that's kind of less topical. And they significantly outperformed all their peers. So focusing on the customer, sticking to fast-growing companies really gives you a really good lens with which to identify, the highest returning opportunities.
Focusing on the fast-growing component, what do you actually define as fast-growing? What are the metrics that you look at? And if you were to, I guess, put a screen to say, no, we're not interested, what is that hurdle?
I think it starts at the beginning. So it'd be users and revenues
Okay.
and gross profits. That approach was really successful for many years. There's like 8 or 9 years where you could outperform just by owning fast-growing companies. Then what happened is like basically the market changed and people kind of realized that's what people wanted. That's what the market was kind of looking for. And then it like summoned up fast-growing companies, out of the ether. Because you can just cut your price in half. I'll sell $1 for 50 cents. Wait, am I saying that right? 50 cents for $1, whatever.
Yeah.
You can just deeply undervalue your products
Yeah.
and then grow really fast. Or you could spend $2 in marketing to get $1 revenue and grow extremely fast that way. So, a few years ago, a bunch of very low quality businesses kind of like listed, and a lot of them don't really exist anymore. There had to be some economic basis. But if you look at the examples I gave before, whether it was Tesla, Ferrari, or Apple, it wasn't just fast growing, right? They were able to command a huge premium.
Yeah.
So that like customer love we talk about translated into higher prices and higher profits because, it costs roughly the same to make these goods for everybody.
Yeah.
So the handful of companies that can charge more, do exceptionally well.
So on that customer love point, it's hard to define, but I think you've given us some ways to define it there. One, it's like, I guess, gross margin relative to their peers. And the other, I guess, is something around market share, given that that's what customers are choosing. Are there any other metrics that you sort of see in a financial analysis, or you just say generally and you say, like, that's a good proxy for customer love?
Yeah, I think you just ask. Ask the people making the decision. So a recent example would be NVIDIA. So I talked about it being fast growing, but obviously if you speak to anybody in that space, they'll be the first to tell you that by far, their chips and the system around it, the software is like far superior to anything out there. And that became really meaningful because, in the first part of the AI boom, which kicked off with ChatGPT, a couple of years ago now, everything ripped. Everything in semiconductors basically went vertical, including things that looked a lot like NVIDIA, like AMD. But most of those sold off, 40, 50, 60%. It was really only NVIDIA that had that huge run and then held on to it. But yeah, again, like if you speak to financial analysts, they'll write an essay on why AMD is a good investment. If you speak to somebody like buying the product, it's pretty clear that unless, other than trying to foster a competitor to NVIDIA, everybody agrees that NVIDIA was superior. And you can do that in other industries as well.
Yeah, I love that analogy because I feel like AMD is one of Twitter's most popular stocks. Like finance Twitter always speaks about AMD, but the point there is, you speak to customers and they're willing to wait months to get an NVIDIA GPU over a competitor's.
Definitely. Yeah. Other metrics are like wait times, which you can see. You can also keep an eye on pricing and discounts. Often pricing is live. So if a company is discounting, that's often a pretty good indication that demand's weak. Like a lot of this information is out there. Yeah, cybersecurity is another example. So like IT professionals all much prefer CrowdStrike to alternatives. They can have a little CrowdStrike agent and just looks after all their endpoints and they just love it and they rave about it without even asking them without even talking from an investment angle, right? Yeah. Just asking what do you like and what do you use. And it's a pretty good lens because one of the traps that everybody falls in, I have to push against it as well, is you always want to go for the cheap number 2 or number 3 or the turnaround. But invariably, and these are big industries, invariably the number 1 wins, whether it's, chips or autos or smartphones. Like these are huge industries. Yeah. Like if you can pick the winner out of those industries, you can do exceptionally well.
Or you bring it back to Australia and it's REA constantly outperforming Domain.
Yeah, it'd be another example. You got a clear number 1, you got a number 2, and then everybody kind of just instinctively gets sucked into the number 2. When really the people that keep it simple and go for the number 1 generally outperform.
Yeah. So you've mentioned a few examples there, but is there one company today that maybe isn't as well known as an Apple or an NVIDIA that fits that definition of explosive growth and customer love?
There's a few. HIMSS reported last night. I thought that was a pretty interesting result. So that's, again, it's products that most people will be familiar with. Sexual health, vitamins, that kind of thing, and obviously GLP-1s and weight loss. They posted 111% organic revenue growth. Pretty high margins.
From what part of the business?
GLP-1s are about a bit less than a third.
Okay.
Came in at 31%. So it's not just weight loss. It's also like the sexual health and, hair loss and all their other, business lines as well. But the customer love bit comes in because they're taking market share from everybody else. So it's a rapidly growing industry. Going to a doctor is a pain in the neck. If you can do it online, it's obviously much better. Performed exceptionally well, growing triple digits. They've only got 2.4 million users, I think, which is huge, but that's very
Small
early on in their
fraction of
growth.
America,
Yeah, and then the fundamental, going back to that customer decision, like why would you go there and not a GP? Like it's just so obvious. If you can do it online. And then another metric that they're tracking is how many people are on personalized plans. So you're just going and getting a subscription and paying the money as you need it, or are you using their services to kind of tailor a plan to yourself? And that obviously has much better lock-in.
Yeah.
And it shows people are not just using it as like an online pharmacy. There's a little bit more to it.
Yeah, and that's growing quickly as well.
So that's growing. That's becoming a bigger and bigger share of their total customer base.
Yeah, okay.
Like growing faster than their top line.
Yeah. Interesting him.
So that's interesting. And that's but then again, we haven't really talked about it a bit. The problem with these companies is they're extremely volatile.
Yeah, well, I'm looking at
we've
the
been
chart at the moment.
we've been on the receiving on that a couple times. So, we've kind of adapted a fair bit. So we basically use risk models extensively. And effectively the momentum models or take profits, with take profits, which kind of really improve your returns. And HIMS would be a good example of that. It's like every quarter they've performed exceptionally well, grown exceptionally fast. They seem to even be accelerating now. But, that was like a 65% drawdown in like 2 or 3 weeks.
Yeah, well, since the start of 2025, it peaked at 184% growth. From that point, it then dropped 62%. And in the last month, it's up 62%.
Yeah, they're wild moves. Yeah. But I guess going back to like how you get started, everybody starts with these value stocks. The issue with those is sometimes they just go nowhere for 10 years.
Yeah.
If you're some random cement company in Europe, actually they're probably doing okay now. But that typical like European value stock, that's not when you're in this part of the market, that's not a problem. I mean, these are super exciting companies. Like they post good, strong results. The momentum comes in. They're very hot. Like hot money comes in. You don't need to worry about waiting around. But then obviously they reverse sharply sometimes.
Yeah.
And so if you are going to play in this space, you have to have a plan for that, I think. And that's probably a way that we've changed over the years. Yeah,
or you just have to be able to hold your nose or shut your eyes and just ride the volatility.
Yeah, but it's so hard because often the market's right. Often something's happened. Like I think basically what happens, like why the momentum approach works, I think there's a lot of people that know what's going on in a company. Like, for example, the entire executive team knows, but not just them, everybody who's selling the product in the company, everybody in the company, all their friends and family. And they're not just that, all their competitors. Everybody that competes with them knows who's doing well and who's not. And they're not just them, it's also like the suppliers, people they're buying from. Are they ordering more? Are they negotiating? Are they, on the flip side, are they offering discounts? There's so much information in the market that is like completely... Like no investor would have any clue if it was a stock that you weren't personally involved in somehow. So I think what happens is like when things are going well, that information just seeps out. Everybody buys. The executives hold on to their stock. Everyone getting share-based comp. They don't sell it. Then at the margin, that kind of stops. And then the stock might fall 20, 30% as slowly the information gets out. And then for most of us, we say, wow, it's a great company. The results are great. It's 20, 30% down. Let's buy. And then the news kind of comes out, because we get it so many months delayed. And then the stock drops another 50%. And then now all of a sudden you've got an underperforming stock that's down 50, 60%. And now you're kind of in trouble. Like the whole reason that you bought the stock no longer exists if it's slowed down. And there's so many examples of that. So these days we're kind of try and stay in these on the uptrends only. Good times only.
Uptrends only.
Uptrends only. Well, I mean, you would have gone on a crazy ride just on this stock in the last 5 months. It's hard to know when
well, the other thing we
to
found
stay in or
really
stay.
improved our approach was to just have a take profit. So if you do, and we put them really aggressive, like 2.5 to 4x. Like if we sold everything that went up 4x, our fund would be a completely different return profile. What happens is invariably there's a moment, which was only like, say, February, where some of these things go vertical. It goes up 180% in 2 months.
Yeah.
You really want to be cashing out at that point. And then invariably you get another chance. If things are running that hot, there's a good chance it's just going to reverse and the long-term thesis could still be intact. Nothing's really changed with HIMS. There was a bit of stuff around... I mean, the complicating part of that was they were getting compound drugs. So they're basically getting really cheap versions of Ozempic and Mounjaro. And obviously that's a bit weird. Like if you have patented drug, you're not supposed You're not supposed to be able to just make that yourself and sell it. But you are allowed to do it if there's a shortage.
Yeah.
It's like a little loophole, and they like drove a truck through it.
Yeah, yeah.
Yeah, but then they came off shortage.
They closed
But that's
that
come back
loophole,
now.
didn't they? Yeah. Well,
Yeah. But so that was the bear thesis, and it kind of played out. But then they're doing what Eucalyptus is doing and just sourcing it from Novo and Lilly.
Yeah.
And actually just announced a partnership with Novo to do it direct. But Ozempic's going to start rolling off patent in a few years. I think next
Really?
year
That
it starts
quickly?
rolling off in,
Yeah.
I think, China, and then it slowly starts rolling off in other years.
Great, we'll be able to get it cheap. We'll be able to get full stop.
Michael, we want to turn to how you're managing the moment right now, because there's no doubt there's been a lot of volatility. And as a stock picker, I guess you can either think about what's going on at a macro level or, work bottom up. How much do you think about the macro in a time like this? Does it play into your thinking at all?
There's two parts to that. So we have pretty tight risk management these days. So there are two parts to what we do. It's kind of global growth in tech and healthcare. So global growth in tech, we used all these models and basically sold pretty early on. And then everything kind of legged it down. But in terms of actually thinking what's going on, I think it's one of those moments that's really hard. I mean, everyone from max long in February to max short. So there's so many momentum players in the market, like CTAs, which manage hundreds of billions or trillions of dollars. There's people that bring exposures up and exposures down based on how volatile the market is as well. So if you see a big down day, you know that the volatility models are saying sell. And so somebody like Bridgewater, which manages hundreds of billions of dollars, they're going to be reducing exposures. And you can basically track what those players are all doing. And they went from max long to really selling all the way down. And you can't really, those things they're better at timing when everybody goes max short. Then you're usually due for a rally. When everybody's max long, it could still be another 6-12 months to go. But it does tell you where you are in the market, just is there a lot of selling or buying ahead? And we certainly reached one at that point where there was a lot of buying ahead, a few weeks ago. So that's positive.
So that initial dip happened, and then you saw that it was going to be buying ahead. The market has sort of recovered from where it was on Liberation Day. What are the models saying now?
They're all slowly flipping to buy the last couple of weeks.
Yeah.
So we bought back a bunch of our stocks, including HIMS, and then I guess now we just wait and see I think for things to go back down, when everything gets that max oversold, something bad needs to happen. So there are scenarios where
Liberation Day 2.0.
yeah, or if you push forward and it caused a global recession, and then everybody had to tighten their belts, and it really looked like that was going to happen. The thing with these sell-offs is there's always a really good reason.
Yeah.
It never just randomly happens. Everything's the same, so I'll just buy. Yeah. It's never that easy. In this case, it was it seemed like every business leader around the world was saying, "Whoa, I'm going to hold back on all my investment decisions and just see what happens." And that's basically textbook recession. It's like everybody just holding back investment, keeping what capital they have tight, not spending, not investing, not hiring.
But that sentiment is kind of coming through at the moment. A lot of the forward guidance that you're seeing is, wow, we're just going to sit and wait. So kind of not contradictory, but it feels like the fact that the market is doing what it's doing is sort of underselling or underplaying those kind of sentiment.
Yeah. I mean, there's a very real scenario where, GDP turns down. There was a negative GDP print followed by a pretty muted inflation print. So the negative GDP print, everything legged it down. That same day, inflation was flat. And so interest rates are really high, so there's a lot of room for them to come down, both in Australia and overseas. But there's a very real scenario where it happens and it's a global recession, and actually later in the year you get a much bigger sell-off, like a big second leg down. In other words, it's going to go up or down.
Yes. Nice.
So, given the amount of uncertainty at the moment, are there any sectors that you are saying, look, there might be interesting companies here, but I'm just not going to touch it given the political uncertainty and how things could change on a whim?
My 2 cents, which is obviously worth very little and as much as anybody else's, but I think they actually are quite serious about moving manufacturing into the United States. And if that's the case, it's not a negotiating ploy. They're not just trying to get a good deal. They actually mean it. They actually want manufacturing back. And if that happens, then that will be painful. That's on a global basis, it's definitely better for stuff to be done at the cheapest, most efficient place. There's no doubt that's optimal for global GDP. You could certainly, the argument is that you could optimize for US GDP, which obviously the Americans might want to do. And maybe it would be better to have more manufacturing there, better for their defence, better for certain jobs. But that's bad for everybody else, you know, and potentially even for the United States, because all these companies are global as well.
So for any new investors who perhaps hadn't experienced a drawdown like that or have just taken this opportunity to get into the markets, what sort of advice would you have for them?
Advice.
Yeah.
Most of the time, these are short, sharp, and being aggressive pays. But it's like 1 in every 3 or 1 in every 4. It turns into like a 2-year horror show. And you really don't want to be involved in those. Like the US tech sector will be fine. It will rebound. So will US industry. You know, the largest Australian companies are not going bankrupt overnight. So if there's a big sell-off in Australia, you know, they're all going to be profitable. And it's just how the market works, right? Like the whole system will adjust so the companies continue making some kind of profit margin. In the worst case, some will go out of business, which will then reduce competition and allow that kind of industry-wide or economy-wide profit margin to be maintained. The other thing I would say is the downside in these companies is 60, 70, 80%. So that was a mistake I made. Like I used to think it was 30, 40, 50% in a worst-case scenario. That's probably true for an index, or more true for an index. But in a stock, you know, the downside, you got to look at 70 or 80%.
Which we all learned in, late 22, early 23 with those
Yeah,
tech names.
it was the second leg down, right? It was like kind of December, January, February, March, huge sell-off. And then it looked like things were stabilizing. And then a lot of those companies got cut in half again.
Yeah.
And these weren't like small or spivvy companies. You know, some of them were quite large. And then a lot of them recovered and went on to new heights.
That's the crazy thing,
Yeah.
isn't it? Yeah. Like Spotify, Shopify, all those companies
Netflix,
just
yeah,
staring
Nvidia.
us in the face.
You know, these are huge drops.
I mean, as you look at the market now, you know, we saw that initial sell-off and then a lot of stocks have kind of ticked back up a little bit. Are there any stocks that are like top of your watch list you're hoping they come down a bit and fall into your valuation range?
There's a couple of things that will be really interesting. It'll be really interesting to see what happens with the semiconductor index, because that's been selling off for a year now. And it's one of the most volatile industries, I should say. You know, it's dropped huge amounts periodically, but throughout our lifetimes, it's been one of the top performing indices as well. You know, the demand for compute going up every year is just one of those things you can like bet on, like it's just going to happen. And it's been a huge sell-off. So Nvidia report, it'll be really interesting to see what happens there. But, you know, we do know that the AI companies are throttling usage, so they're at max capacity. So there's a bear case that people buy less chips and, you know, maybe the hyperscalers have built enough data centers and, you know, they probably went from investing this much to that much and maybe they're just going to invest that much for the next few years. But at the moment, we haven't seen that. At the moment, that demand's still growing. We just had all of big tech last week, or most of big tech last week, and they're all pushing ahead with their CapEx plans. So the combination of a sell-off, a year-long sell-off, plus continued demand, it'll be interesting to see if there's a rebound there. The other thing that got I think unfairly smashed was healthcare, which, you know, we were like 40-50% cash, but 40-50% healthcare, and that stuff got cut in half or more on no news. So it was basically like everybody in the US was freaking out because all the changes in leadership there, they're obviously very hostile towards big pharma and fired a lot of people in the FDA. I think that was probably overplayed. Like the FDA commissioner came out and said actually he wants drugs to be done faster. And he gave like an hour-long interview. I challenge you, like if you listen to it, you'll agree with every word he says. Even the time taken to bring drugs to market seems exceptionally slow. You know, the need for placebo-controlled trials in very rare diseases is a challenge. And there's a lot of people that think actually people should be allowed to have more freedom in choosing experimental therapies. Like if you know there's an experimental therapy, you should be able to choose to do it. And even going on a trial and potentially being in the placebo arm, even that can be controversial.
Yeah.
Like if your parent's sick or you're dying and you go on a trial, you want the drug, you don't want placebo control.
Yeah, that's true.
Yeah. I mean, to be fair, usually in those situations, it's standard of care versus the drug. But still, you might want the experimental thing that might give you a better chance. So they're kind of aware of all those issues and that settled things. Then in Australia, we had the Opthea collapse, which then put the whole local market into a bit of a tailspin because you had big public funds heavily invested in that company. And they're almost certainly stepping back from the market now. And, you know, it's a shame because if that worked, there would have been billions of dollars of value and everybody would be all bulled up and excited and looking for the next one.
Yeah, true.
Instead, all the people that were in it, like discredited internally Whoever the analysts were are probably discredited, and the PMs have very little appetite for doing that kind of thing again, which is a shame.
Yeah.
But it's also
It's a
an
shame,
opportunity.
but it opens the door for you as a biotech investor.
It does. Interestingly, like the biotech people I knew were mostly not invested in Opthea. It seemed to be more generalists that were interested.
Which is probably a red flag in and of itself.
Yeah, it could just be my circle. So I'm not saying that nobody invested that and the others doing. Absolutely not saying that. But it was something I noticed that I was like, wait, were you in this one? It's like, no, was you in it? It's like, no, I wasn't in it. I was like, oh, well, at least we all missed that. And then obviously didn't foresee that would cause everything else to plummet the way it did.
Yeah.
I think in these moments, nobody looks. If you've got something that's coming out 2 years ahead, even with a high degree of confidence, nobody really cares. Everyone's looking a few months ahead.
Yeah, right, okay.
It's like your time horizon just comes straight in.
Yeah.
And you discount anything that's happening more than 2 years ahead. So I guess the price, that obviously means prices are really low. So if you have high conviction over something that will get approved in 2 years' time, you can pay, costs almost nothing for that. You can get a huge amount of stock for very little. So the opportunity set is definitely there in healthcare and biotech.
Love it. Well, Michael, we're going to take a very quick break. And then on the other side, we're going to discuss how AI can be an investor's superpower. So we'll be right back. This series wouldn't be possible without the support from Superhero.
Superhero Super is a low-fee, award-winning super fund with a wide range of investment options and the flex to invest directly into ASX-listed shares, ETFs, and more. Superhero Super is primed for performance. Superhero also won the 2024 Excellent Rates and Fees and Best for Direct Investment Awards by WeMoney Superannuation.
Now remember, Superhero does not provide financial advice, so consider whether their product is right for you. Read their PDS and TMD and download the Superhero app at superhero.com.au. Interests in Superhero Super are issued by Diversa Trustees Limited as trustee of One Super. Superhero Super is a subplan of One Super. Welcome back to Sidekick. We're here with Michael Frazis, the founder of Frazis Capital. Now, Michael, obviously AI is starting to become something that we all use every day. It's something that I think we've started to use on the show before when it comes to our own investing. How are you using it in your investing process?
There's two ways. Firstly, in terms of building our first risk models, that was all done with AI. Now we've got a couple of software developers. They're like redoing everything. They're doing a much better job.
There
Is
we
that
go.
a good use case for AI?
That's a good example where AI hasn't disrupted all human jobs yet.
We used it. It was shit. We got in humans.
And the software developers are very sensitive about AI. They keep saying we're not going to use it. We're not going to use it. So I don't know, guys. It's pretty good. It's getting better as well.
Yeah.
But I think in those big projects, it's not quite there. Even the best, even Cursor AI, even the ones where you upload your whole code base, once it gets beyond a certain scale, they find it very hard to do. And then obviously, how do you know if the change was good or it's not going to mess something up? Or it probably will get there though at some point. The other thing is like deep research is incredible. Like you have to pay up for it.
Yeah.
But if you want to look up, particularly in biotech, like anything where there's lots of textbooks, lots of technical papers, getting to summarize those with references in like detail, like in like 5 or 6 pages.
Yeah.
It's pretty incredible.
It is.
And like in the stuff that I've looked at, I haven't really noticed that many errors, like a couple.
Yeah.
Like maybe they only, if you're looking at a specific company, it'll miss anything that happened after 2023, or a company-specific occasionally you see little errors. But in general, on the big stuff, like how does this mechanism work? What drugs have been used to treat this? How did they work? What are the problems? Why would this potentially not work? Really good at answering those kinds of questions.
So deep research is a ChatGPT tool. Are there any other like platforms or tools that you think investors should know about?
There's a few that there's one called FinChat.io, I think, that I use sometimes. But I find I never use the AI features. So far I found there's a lot of platforms that like ask questions and, what was the revenue? I've never really found any use for that. Like firstly, if it's company information, the companies are pretty good at getting that out at you. Secondly, like if there's any errors, like it's just easier to go to the source document sometimes.
I guess, have you seen any companies that you're investing in or researching that have been able to integrate AI into their business models effectively?
It's hard. I mean, on the venture side, we've invested in a couple of companies that will automate receipt management or NDIS software or things like that, and that will definitely happen. Like bookkeeping, accounting, that kind of thing, I think will be pretty good. But again, you've still got those issues of 99% or 98% actually is not quite enough.
Yeah.
You can't need to go all the way, so they're not quite there yet. If you want to invest in the trend, it's pretty hard to go past, NVIDIA, Taiwan Semiconductor, the people that have to make it, if they're just going to capture that increase in demand. And again, the context of a big sell-off suggests there's an opportunity as well. So it's not like you're buying something at all-time highs. There's actually a lot of investor pessimism around those companies at the moment. So from an investor perspective, that's probably the easiest way. But I think a lot of those are going to be zeros, right? So there's OpenAI. How many different large language model companies are there? There's no way that they all survive. They cannot all survive. So you might have ChatGPT. Meta's not going out of business, so they're going to have a relatively open version. DeepSeek has open weights, so it looks like the Chinese are just going to every now and then release an open weight model where you actually know you don't just, it's not just open source, the actual weights. So you can just, once it's there, they're out in the open forever for anybody to use for free.
What does that mean, open weight?
Open weights mean, that's like kind of the numbers in the matrix that they use, the actual matrix that they use or matrices that they use to do the calculations.
Wow.
So if you know that, you have the model. You can just put it on, your own computer, probably, a larger computer than that for the really good ones. But you don't need to use DeepSeek. You don't need to use anyone. You don't need to be connected to the internet. And so it's in the public domain. And they're only like maybe 3 to 6 months behind the leading edge. But then there's so many companies. So what happens to like Anthropic and Claude? What happens to, Iliad? Like all the OpenAI founders have spun off and set up their own companies.
Yeah.
What happens to all those? Will they get any customers at all? They've got huge investor demand, but there's just no business model. I mean, even OpenAI has, question marks over that. Though coming back to that customer love explosive growth, that would be the one.
Yeah.
So, every time there's a Google model released or a Llama model, or even DeepSeek, top of the charts and then all the way back down. But then ChatGPT has mass market share, growing super fast. That's the one everyone thinks of. That's what everyone uses.
That's the one regular punters go to as well.
It's got the mind share. And it's not hard to, and it's a pretty good product. It's the easiest
awesome.
to use.
Yeah.
Your folders, it's got all your chats. There's probably some degree of stickiness there. So if you do true customer love explosive growth, you'd probably stick with OpenAI, ChatGPT. That would be the bet.
So with the AI story, we are also seeing some of it unfold in the biotech space that you're sort of focused on. Google's AlphaFold and some drug discovery. I think there was some new form of antibiotics discovered using AI. Are you seeing anything interesting emerge there?
I've looked at there's a few of those companies listed in the United States. I've looked at them pretty closely. I'm kind of a bit skeptical on them though, because the problem is finding new interesting potential drugs is not the problem. It's actually, we've got a huge bank of interesting things. It's very few of those are actually developed.
Okay.
You need the inhuman data. Drugs it's so hard to do drugs because they have to work in basically every model up the chain without killing them. Starting with from the cell to a small rodent to a primate. It has to work for all of them and not kill them. A dog. These are species with very different chemistries.
Yeah.
And then it has to work first in human. And that whole bit, that's the roadblock. It's not actually finding a promising new drug. There's heaps of super interesting candidates on the shelf. Actually, it's the opposite. Drug companies are very challenged in what they find it really hard to find which candidates to invest in.
Yeah.
So these companies have spent a lot, and you look at their numbers, they're losing hundreds of millions. They're spending hundreds of millions a year. What's the model? You get a blockbuster in 5 years' time. I think they're really hard from an investment perspective. It's kind of nice that they're being funded, so good for them, and I hope it works out. But I think it's hard. Biology is we're not there. Software development will probably be the first thing that's properly cracked. You've already seen huge headwinds, but it's still nowhere near working on an enormous code base.
Yeah.
But that's something you could see happening in the next few years. But something as complicated as a human, it's further away.
Yeah.
I think it'll increase the pace. It'll certainly increase the pace of everything. So, time that would have been spent going through journals, back in the day going through physical journals.
Yeah.
I remember at my university there were shelves and shelves of all the back category of all these obscure papers. And now obviously it became really easy to search that with the web, and now it's super easy to get summaries of everything. So the pace, the speed at which somebody can learn and get up to speed is definitely increasing. So I think that's definitely real. It's just whether we've got this new protein that's going to fit into a lock and a key into this enzyme and inhibit it. It's well, great. So who's going to spend the $50 million to get it to first in human? That's kind of the roadblock.
Yeah.
And I think people like misunderstand that sometimes.
Now, Michael, you came in with some exciting news today. I think we might be the first to break this. We love breaking news here at Sidekick. You've been running Frazis Capital for a number of years now, but it hasn't been available, on the ASX to people like Bryce and I. But that's all about to change.
Yeah, we're actually launching an ETF very soon. So it's with the ASX at the moment. So we're still going with the final, approval and getting all the details together. It'll just be kind of global growth and global tech. So we'll keep the kind of biotech stuff out, partly because it's too illiquid. It's probably a bit too risky as well. It'll be kind of like a tamed down version of the current strategy.
Yeah, nice.
But there's plenty of movement in the global growth tech, I think.
Tamed down is relative when it comes to your investing strategy,
Yeah, but I think it's exciting because it'll be an ETF, it'll be listed. You can buy $1, you can buy $10. It doesn't have those issues you have with funds. You can access it through any broker. It'll be so much easier from that perspective. And I think also there's very few ways to get access to these super fast growing US tech companies. Most of the funds are very heavily weighted to big tech. But if you're going to invest in big tech, you're probably better off in the passive indices as well. If you want a little bit extra, for a small part of your portfolio, that's kind of where we want to sit.
Yeah.
And if it's listed, it's so much easier. So, yeah, we called it Lioncrest. The ticker will be ROAR, ROAR. So keep an eye out for it.
Yeah, now don't go to Superhero yet and search for it because it's not ASX listed yet, but make sure you make a note of it. ROAR, good ticker. But that's exciting. We're excited to see that come onto the market.
Great. Looking forward to it.
Well, Michael, that brings us to the end of the episode. Thanks for joining us today, and we'll speak to you again soon.
Thanks so much. Thanks for having me on.
Now, if you've enjoyed this episode, make sure you subscribe wherever you're watching or listening so you don't miss a future episode. And if you're interested to learn more on how you can grow your wealth like a superhero, head to superhero.com.au/invest.